I don't think there is an answer to this at this point in time. So, you do see specific markets which actually now introduce moratoriums on building new data centers, right? Until there is a solution for the power, because ultimately data centers are very important to our day-to-day lives these days. But at the same time, we cannot be blind to the fact that that energy that's being produced is also needed for other parts of the society.
So today I'm joined by Maciej Tarasiuk, Head of Investment within the Economic Infrastructure team at Aberdeen. So you lead investment across a diverse portfolio of mid-cap infrastructure businesses throughout Europe, spanning sectors like energy, transport, digital, connectivity, and utilities. You are someone who's not only deeply embedded in the world of infrastructure investing, but also passionate about long-term value, sustainability, and partnerships with management teams. So thank you, Maciej, for being with us.
Thanks for having me on, Thomas.
So to kick things off, could you walk us through a bit of how you think about the infrastructure space and what defines core and core plus infrastructure and why this asset class is important today?
Yeah, and look, perhaps let's start with your last part of the question, because I think that's quite important. Why do people invest in infrastructure? And really, when you boil down to it, it is about that additional to a diversified portfolio. It is a asset class, like many other real asset type of investments, which do provide a good diversification, but also very low correlation to other asset classes like listed equities or debt. Does provide that kind of good diversification in a portfolio. The other reason why people really like investing in infrastructure is really focused on some of the key objectives that it delivers. So essentially, a lot of the infrastructure assets provide essential services to local communities. They provide quite stable cash flows, but also with that comes inflation protection, which is quite important in many portfolios, as well as delivering yield to investors. So it's not just about capital gains, but actually it's about those assets which are already operational and it can provide ongoing distributions to the investors. When it comes to then fitting where does core and core plus fits within the wider portfolio, normally infrastructure is really kind of characterized in three different buckets. So it's core, core plus, and value add. And the key part of, the key differentiation between them is really focused on the risk return profile of those three. So based on where people target returns at the moment, just to give you a bit of sense, core normally fits in the 9 to 11 bucket. You then have core plus, which fits into 11 to 15% returns, and then value add, which is the most has the highest risk, but also has the highest return potential. So this is 15 plus type return investments. Maybe just to bring to life a bit, what we define as core plus. And for us, it's really, as you say, we invest across three kind of key segments. It's transport, energy, and digital space. And within that, from energy perspective, it can be anything from district heating assets or electricity distribution assets that we own in Finland. It can be renewables, so whether it's solar or biomethane generation. Transportation, we focus primarily actually on leasing. So this is about passenger rolling stock leasing or ground handling or airport ground handling equipment leasing type businesses, which have longer term contracts, which don't also take risk on how much on the usage. So those are more kind of take or pay type contracts. And within the digital space, that's mainly actually been focusing on fiber to date. So again, providing that almost utility service in a world where digitalization has become more important.
Okay, thank you. And so you also specialize in mid-cap infrastructure, so you wouldn't invest in any sort of businesses, even across those sectors. So how do you define that part of the market, and what kind of assets or sectors would you be focusing on the mid-cap, let's say, section of the investment world?
Yeah, it's an interesting point because when you speak to most of the managers, everyone has a very different view in terms of what a mid cap means. And you've got funds which, can raise multi-billion type funds, which are called mid-cap, or it can be funds like the ones that we manage, which, are around the €1 billion mark. So our definition of mid-cap is very much about investing equity check size of 50 to 150 million for either full ownership or majority ownership. So tends to be, EVs of the companies anywhere between 3 to 500 million as a maximum. So I would say we play the lower end of the mid cap, given, where some of the other funds that call themselves mid cap are. And for us, that's an interesting part of the market driven by a couple of things. So one, there's very few managers that actually look at that space, which means that actually there is a lower competition when you look for new opportunities. So we calculated there's probably 80% of all deals in that lower mid-market space. And if you, translate that to how many managers there are, there's probably twice as many deals per manager there than when you look at actual larger mid-cap or large cap transactions. And that's actually quite exciting when you look at, as I said, origination, but also, those companies are small, and, we do see that through active asset management, you can really kind of create additional value for the investors during your ownership and then at the time when you divest those assets over time.
So it's quite interesting, actually. Like, so you develop the strategy also taking into consideration competition.
Correct. So, we want to play in a market which is additive. And, when we look at, our underlying investors, what we do in a lot of cases is complementary to, some of the other infrastructure managers that they would be investing with.
Okay. And so what makes infrastructure investing different from, let's say, other private equity types of investment? So you mentioned value-added infrastructure, which is very close to private equity. So what's essentially the distinction, really, if you could make one?
Yeah, I think it goes back to a couple of things. So one is, in our mind, infrastructure is about, having that kind of brick and mortar feel. So it's about you really being able to, touch and feel the assets, which doesn't always happen on the private equity side of things. I think the other side is about ensuring that the investments that we look at really provide that long-term stable cash flows. And that really happens from either assets having a natural monopoly position. So it could be, as I say, kind of a regulated electricity distribution where you have that natural monopoly and it's essential service for the end user. But it can also be driven by long-term contracts as well. So, we do see that a number of our assets will have a long-term take or pay contract. And again, that provides that long-term stable cash flows. So I think it is about, as I said, brick and mortar, first of all.
Mm-hmm.
And then secondly, it is about that predictable cash flow, which is really driven by the essential nature of the asset.
Okay, thanks. So before we get into a bit more details on your investment strategy and how you run investments, would you mind giving us a bit of background and on your journey and cover what you've done so far, etc., and also explaining what keeps you excited today within the infrastructure world or even the investment and investing world? And just for fun, what did you want to be when you were a kid, and does it really match with what and who you are today?
Well, let's start with the last one. So I want to be a pilot when I was younger. So I guess most of the boys will want to be driving something or flying something. So I wasn't any different to that. Whether it matches what I do today, I guess, in my previous life, I did look at airports. So that's close enough, I guess, to kind of aviation that you're going to get. But look, actually, interesting enough, basically, since I started working, I worked in infrastructure and kind of financing of infrastructure. And that was already, since my internships. And what attracted me at the time to infrastructure probably still kind of attracts me to it now, which is really two kind of key things. So one, infrastructure is very interesting because of its complexity, especially infrastructure financing is interesting because of its complexity of really marrying up the financial objectives that we're trying to deliver to our investors, but also owning assets which do provide essential service to local communities. So those are very important for the prosperity of the local communities, which comes obviously with quite a lot of responsibility to ensure that what you're providing is the right level of service and is actually affordable to the communities. that interface is actually quite interesting and important to get right. I think the other side, and I think that infrastructure community has probably been sometimes receiving quite a lot of bad press around this, but I actually do believe that in the long term, if you get your investment right and you get your stewardship over the asset right, private ownership for infrastructure assets it's a better place. And that's really about that longevity of views. To give you an example, our funds are 10 to 12 years or in tenor. That's normally spans 3 or 4 political life cycles. So you do have a much longer term view that you can apply to your investments. And if you think about that kind of long-term sustainable value, you do actually benefit the local community as well by ensuring that
Mhm.
it does provide the right service and you've got that license to operate and grow over time as well. So I think it was exciting almost 18 years ago. I think it still kind of holds true, and I think in the current geopolitical environment it's even more important in many ways.
Okay, understood. So now getting to investing. So how do you typically approach a new investment, really from sourcing and evaluating opportunities to creating long-term value? And how do you balance having a consistent process with a reality that every deal and every company is somewhat different?
Yeah, I mean, you are right that every deal and every company is different, and every process
And
has
people are
various.
also different.
Yeah, and it has many twists and turns as you go through it. So there isn't kind of one size fits all in many ways, and I think that's partially why it's quite interesting looking at private markets and infrastructure, especially. I mean, I guess to start off, the process of kind of asset selection starts way before we even kind of get to a point of talking about an individual asset. So, to give you a sense, we spend quite a lot of time actually really mapping out the market. And what I mean by that is really identifying, first of all, what are some of the key mega trends that affect infrastructure, and which mega trends we want to kind of play into. It is then about really marrying up the skill set within the team with those mega trends, with the fund objectives, to map up almost, what are the key industries that within the infrastructure space that we want to follow. So there is it's more kind of, at the boiler room type. We essentially as a team have a heat map in terms of, key industries that we want to target. And that really supports then being much more focused on origination and finding new opportunities. See, once you kind of get then into kind of identifying key targets that you want to go into, it really then goes into a more common due diligence process. And the way that works from our perspective is really obviously our own internal resources. But importantly, at that point in time, we do bring some of the senior advisors that work with us, as well
Mhm.
as external advisors, to really be able to due diligence the assets. And it's not about just due diligencing risks, but it's also due diligencing other opportunity and upsides. So that when we create the overall holistic business plan and the asset management plan, we have the right targets set in place, but also we have the right resources around the table to be able to deliver the objectives of that investment and what's been actually targeted within the business plan. I think, it really then kind of moves into asset management, but actually the starting point of the asset management is actually what you have due diligence beforehand. What are some sort of key deliverables that you saw as being vital for the success of the investment as well? So you've got a very kind of consistent approach across the whole investment life cycle.
Okay, so. I mean, if there was like an average, how long on average does it take to, let's say, create a deal from the first time you hear about a company or an asset to the day you essentially own it?
This can have the range is actually quite high, right? I mean, some deals happen very fast and they can happen in within 3 to 6 months. Some actually
Hmm.
take much longer, and that's really driven about find the right partnership and having those conversations. So, we have looked at opportunities in the railway space, which have been a very successful platform for us. But it took us probably, good year to year and a half to establish the partnership with the developer to create the right platform to be able to successfully address that market. Some of the other deals which are faster because they're more kind of structured auction processes, those can be faster just because, the lead time between, starting a process to ending is driven by sell side, which normally, is a shorter process.
which you don't really like, I guess.
Yeah, look, I mean, the auction processes work in certain spaces, and I think sometimes they're important, right? So, for example, when it comes to privatizations of assets, which we have been quite successful, for example, in Finland, there is a rationale for why it's an auction process, right? Because it's a public body looking to divest an asset. It needs to be a well-defined process, and it needs to adhere to, stringent scrutiny, I guess, political scrutiny over time as well. I guess where we've, a lot of people say, look, we like bilateral deals, and that's all we focus on. I think the reality is that most deals will have some sort of price discovery by the vendor just to kind of understand where the pricing is. Whether it's a full auction process or it's a kind of a shorter, price discovery period, and then you go into bilateral, those will depend on the situation. But I think where we tend to focus is less about bilateral, not bilateral. I think where we tend to focus is a primary deal, i.e., are we the first financial institution owning those assets? Because we do we do see that there's actually quite a lot of benefit of being the first investor, to a financial investor to introduce almost the asset into that kind of financial investor sphere. And that's both in terms of opportunity from origination side of things, but actually also then being able to uh, professionalize those companies, corporatize them over time, and grow them before you divest into kind of a wider audience of potential investors.
Okay, so it's touching a bit like my next question is really once you've invested in a company, I mean, how hands-on are you as an owner? What does active ownership really means to you and maybe in your world? What makes strong, effective relationships with management? And really, how do you approach board involvement, generally speaking?
Yeah. Yeah. So I guess the way we focus on asset management is really as a starting position, we invest into companies, and we like to invest into good management teams as well. So, that's the first driver in terms of value, is ensuring that, you've got a good management team that can deliver the business plan. That doesn't mean that, we don't get involved, but actually the principle is very much about understanding where the management has key strengths and ensuring that, give them the latitude to be able to deliver on those. And then it's really kind of sitting down with management to identify, okay, where are some of the gaps, and where our team or our senior advisors can really add value as well. So it's very much a hand in glove type approach, rather than, overseeing all parts of the processes, because I think at that point in time, that doesn't really allow the management, who, are credible individuals with a good know-how, to be able to deliver where their expertise lies. And that's actually quite important in that kind of lower mid-market where we invest, because ultimately the companies are smaller and the management teams are leaner. So there are definitely areas where we can work very well together in order to actually be additive to what the management team does. So to give you an example, our teams do get involved quite a lot on potential capital structuring initiatives. So, financing and refinancing, it's something that, we know quite well from even the M&A side of things. And the management teams don't always have, large treasury departments with that know-how. So that's an obvious example. But actually, we also use the benefit of our network. So we, at the moment own 21 investments, to be able to really introduce processes across wider portfolio. So ESG is a very good example of this. So our head of ESG kind of works quite a lot with the management teams in terms of establishing all the ESG processes. Not just because of us as a financial investor, but actually, a lot of the regulation now requires a lot of the companies, to disclose various KPIs and address various ESG issues. So he's able to work, potentially at the beginning of one single company, get the right process in place, and then being able to replicate across the other assets as well. And I think that's actually quite a positive way of, us being able to be helpful to the management teams, but also finding, efficient way of being able to distribute it across that know-how across various parts of the portfolio. we do a lot of these kind of common initiatives where there is a common seminars about sharing information, but
Mm-hmm.
also having kind of common objectives afterwards. So we've recently done something on cybersecurity, for example, where we brought all our Finnish companies together really to get to a point of understanding, okay, what's the best in class approach to cybersecurity? What can the companies do together to actually be able to protect themselves further? And that has, led from that information sharing and, interesting input, not just from within the companies, but actually from sectorial experts in that space, but then really into taking it forward and setting up task groups, which, over time should better all the companies in terms of that specific topic.
Okay, so I mean, you touched upon a few points like regarding my next question, which is really how you support their evolution during your ownership, evolution of the businesses you invest in, and what sort of levers do you focus on to drive long-term performance and sustainability? So you mentioned recruitment of key people if the company lacks of certain types of professionals. You mentioned financing, mentioned ESG, and you mentioned some form of training and professional education. Do you have some sort of a playbook once you've invested in a company which helps you push forward the development of the company very quickly? Do you have some form of a playbook? I mean, VCs, for example, or startup studios speaks a lot about having a playbook to execute. Do you have something relatively similar in some way?
I wouldn't say it's a kind of a play, but I think, infrastructure assets are normally more established assets in general, right? And therefore, I think there is, you have to be more flexible in terms of what that asset does. But there is clearly, as part of the due diligence process before we enter, that process does allow us to really kind of identify, okay, what are some of the kind of key levers that we want to pull, and actually almost creating an action plan for when we get into the ownership as well. And really, if I think about what are some of the kind of key initiatives, and those normally play out across most of the investments, right? One is, how do you grow the companies, and that can be organic and inorganic. I think organic, that really kind of drives two ways, right? One is around how do I grow top line, so really finding adjacencies to the existing operations. So, for example, our district heating assets in Finland are now looking at energy as a service, which is a different provision of energy and heat purely to industrial customers, where it's about providing that kind of essential source of energy and mission critical equipment. But it can also be driving efficiency within the companies as well. Inorganic, look, especially in that kind of lower mid market, I think it's something that has been well and truly tested within our strategy. And so, to give you an example, we made 21 investments, but we made almost 50 bolt-ons to those investments. So it's kind of an interesting way of growing and kind of consolidate the market in a fragmented environment. You then go into kind of professionalization, which you just talked about in terms of processes, management teams, etc.
Mm-hmm.
It is about then finding the right capital structure to support long-term operation, but also growth of those companies. I guess the
Mm-hmm.
last one is ESG, and it's about finding that, especially from the way we look at it, it's finding that linkage between ESG, but also short and long-term value to the company. So it's not just about ESG for the sake of ESG, but it's actually about, okay, well, how do I get two benefits in one go, which is, yes, the companies operate at a high ESG standards, but actually, can they also deliver more value to investors through that as well?
Okay, so maybe can you give us an example? I mean, could you quickly define ESG for you? And would you be able to give like let's say a very precise example explaining, how ESG improvements have directly impacted like financial value? Because I think like I mean, still today, it's very hard to understand, well, except when there is a regulation, etc. So, I mean, you do X and you have the right to operate, or you don't do it and you don't have the right to operate. So that's very simple, but it's very often very hard to link ESG criteria to actual value add and maybe, financial performance.
Yeah, and you're absolutely right on the last point, especially on the fact that a lot of the people talk about ESG is about kind of long-term value. And obviously you only see that at the end based on the multiples that you, I guess, you sell the asset. And then it's still very difficult to define, how much of that was actually driven by ESG. So, from our perspective, it's also kind of thinking about that short-term profit and how can ESG drive that. And, to give you an example, it's quite a recent actually example. So it's one of our utility assets in Finland, which essentially does two key things. One is distribute electricity. So it's got a electricity grid, but also provides district heating. So it generates the heat and then distributes from the kind of heat pipes. And earlier this year, we've actually had an initiative of leasing some of our land to a data center operator, where the data center operator was able to install the data center, a module data center, essentially close to our district heating production plant. The benefit to the company was, the benefit to a data center provider was that actually we, as you know, one of the biggest issues with data centers is about getting grid connection. But because of the location of our utility, there was grid connectivity. So, they were able to kind of get connected pretty quickly to get the electric feed. But also, as part of this, we were able to connect the data center to our district heating. So all the excess heat, rather than being dissipated into the air, was able to be pushed into our grid. And why is that important from our company's perspective? Was we've got additional revenue from connection to the electricity grid, and obviously from usage of it.
Mm-hmm.
But we also were able to get a very low cost of heat into our district heating network, which at the same time displaced some of the biomass that we were burning. So biomass is already deemed as a kind of renewable heat source anyway, but actually once you kind of get into everyone's now focusing on getting to complete non-combustible heat sources. So what we're able to achieve in a short term is about 25% decrease in our costs linked to heat sourcing.
Mm-hmm.
But actually we're also able to reduce the operating of the boiler by 50%. So during the summer, we don't use the boiler at all. It's all coming from the data centers. So you can see there's a true environmental impact there. But you also have, it goes straight to your bottom line as well in a short term. And so, go back to what I said earlier, a lot of the kind of the business planning, when we look at new investments, part of it is actually around, identifying those ESG targets and identifying how we could potentially drive short-term value as well. And those get put into the business plan that we then look to deliver.
So how do you approach ESG when a company has never thought about it? Would you still pursue the investment, or would you say stop? We can come back when you have changed X and Y, or are you saying okay, we can work on it together? So how do you see essentially ESG in the evaluation phase? Is it really a dead end for you? It's completely avoided by the company, or?
Yeah. So look, there's definitely minimum standards that, we need to adhere before we make investment, right? And that's, environmental, there's certain asset types that we're just not going to invest in because we just don't believe it works from kind of minimum ESG standards and actually long-term viability. Coal is a very good example of that, right? The same goes into kind of the E, S, and G, right? So there will be minimum standards that we would expect the company to have day one, both in terms of governance, but actually more social issues as well. So whether it's, to do with its own employees or how it interacts with the local communities. But beyond that, we do see that actually part of our value add is to be able to then really improve the ESG approach. And, as I said earlier, we do work hand in glove with the management teams to be able to support them on that kind of ESG journey as well. And the idea is that, between when we enter and when we exit, there is that kind of significant step change in terms of ESG approach. And it's not just about reporting, process, etc., but it's also about, have we been able to achieve or delivered a company which is, more environmentally friendly, and by the time you look to divest, it means that people do see that there's a longer term viability of that company and potentially less capex to be spent in terms of conversion or energy transition. So it's part of part of what we do. I guess when you then look into kind of European legislation and how we categorize various funds. So we are not, looking to be an Article 9 fund, which is quite restrictive in terms of, what you can invest in. We're more focusing on Article 8 funds, which gives us more latitude in terms of type of investments, uh, but also allows us to be more active with the ESG going, once we invest into those assets and being able to transition them over time as well.
Okay, I got it. So moving on to maybe how you've seen the market moving and where you see it going with your crystal ball. So infrastructure investing has evolved quickly over the past few years, so from energy transition to digital infrastructure. What are the dominant themes of the moment you are seeing in Europe, and how is that shaping your pipeline in some way?
Yeah. And I mean, just before I answer that question, I think it's important to note that one of the beauties of investing infrastructure is that the market actually doesn't move that fast. So, what was defined as core infrastructure 10, 15 years ago still continues to
You
hold, right?
mentioned your 10 years investment period. Yeah, true.
Exactly. But it's also that kind of even longer term predictability, right? Because it's about, period under your stewardship. But then when you divest the asset, you hope that actually a lot of the things that were true when you invested, still are there, right? So, I think when you think about things like, utilities, energy provision, etc., those themes will continue to be there. But you are right that there has been a number of asset classes which have changed somewhat. So obviously, data centers and fiber have become more prevalent than perhaps they were 10 years ago or 15 years ago. But I guess the key themes at the moment are, in my mind, are energy transition. And it's not just about renewables, but it's also about actually having a much more pragmatic approach to how do we decarbonize the economy over time.
Hmm.
So, for example, I would say 2 or 3 years ago, there's been a very big hype about, hydrogen and hydrogen economy. I think we're now kind of seeing much more focus, not just about, those exciting, shiny new things, but actually about understanding, okay, well, how do I transition the economy and decarbonize it
Hmm.
in a kind of cost-effective way? Which leads me to a second point, which obviously plays quite a big role, is the geopolitics. It's not just about kind of the global geopolitics and what's happening in the various countries, but it also means about that kind of political focus on ensuring that essential services are priced in the right space for what's affordable for the end customer as well. And I think we will continue to see a lot on that side of things as well.
Okay, so talking quickly about digital infrastructure, so especially data centers, because you mentioned it a bit earlier. I mean, that space has seen like a massive surge with AI, etc. How do you see that trend evolving? I mean, do you think we are at the beginning, in the middle, or I mean, we are reaching some form of cap? So where do you see the next wave of digital opportunity? Really?
Yeah. So look, I mean, what's actually quite interesting, just if you look at data. So already about half of all data center capacity is actually used for AI as of today, right? And we're right at the beginning of that journey in many ways.
Hmm.
And if you look at all the projections, the data center usage for normal things like storing data, etc., is going to remain relatively flat. There's some small growth, but actually then you've got massive growth being predicted for AI workload. I think one of the kind of key issues that everyone's now focused on is about perhaps less about, is there enough data center space, but actually, is there going to be enough power to be able to support that without having impact on the wider economy? So, in my mind, building large hyperscale type facilities, that's an obvious area, and a lot of people are looking at that. But I think there needs to be much more focus on how do you address that power need as well for data centers. And it's about not just about, I guess, cheap power, but actually data centers also need to have, very reliant power where renewables are not always the kind of the final outcomes. So I think there's going to be quite a lot about thinking about driving more efficiency with data centers to
Yeah, I
actually
was going
reduce.
to ask, like, how do you reconcile essentially growth in data centers, which means growth in consumption of energy with, clean energy and impact on the environment? I mean, it seems to be very hard to reconcile in some way.
It is. I don't think there is an answer to this at this point in time. So, you do see specific markets which actually now introduce moratoriums on building new data centers, right?
Hmm.
Until there is a solution for the power, because ultimately data centers are very important to our day-to-day lives these days.
Hmm.
But at the same time, we cannot be blind to the fact that that energy that's being produced is also needed for other parts of the society. So I think there may be kind of a natural slowdown just on the basis of until the power gets sorted, that there may be slowdown in terms of how much new capacity you can be building. Um, but actually, what's interesting, it also creates potential for new countries to benefit from that data center boom outside of the kind of obvious regions like the FLAP region in the past.
Okay. And so generalizing a bit, and again, like using your crystal ball, I mean, looking ahead like 5, 10 years, which is not too long for you because you hold your companies like for an average period of 10 years. What types of infrastructure asset do you think will define the next generation of core? And what's still maybe being overlooked today?
Yeah. So I think that there's two things. So what will become core, and I think the obvious one, and that's been there for a while, is fiber. To date has been probably more on kind of core plus and potentially even value add, just because there's been kind of quite a large build out. But I think once that build out stops across various geographies, I think that will become almost the fourth utility, alongside water, electricity, etc. So I think that will definitely see stabilization over time, but also the return compression as well, as it becomes such an important part of day-to-day life. I guess the one thing where there's been a lot of conversations about probably less investments today is around resilience. Um, so I think we will start seeing more focus on ensuring that whether it's power generation, grid stability, etc., there'll be more companies which probably at the moment are more in that kind of core plus value add space will become core part of the energy network, for example. I think the other kind of interesting part is obviously here's the sectors that people look at, but when you look at the more short term, I guess you also think about you know where where the assets are most competed at the moment, and a lot is actually driven within our market by the fundraising market. So I would say over the
Mm-hmm.
last 12 to 24 months, there has been slowdown in fundraising. I think that's been driven very much by just the macroeconomic climate. It's been driven by higher interest rates, which do have quite an impact on infrastructure, given the way the capital structures work, the kind of the long-term nature of cash flows. That pot of money has really kind of gone into kind of very large cap investors. So it's going to be quite interesting in my mind what happens in the next 2 to 3 years, where there's a lot of
Mm-hmm.
dry powder, a very large cap space, and there's not that many assets inherently in that space to go after. So it becomes quite a competed space.
Mm-hmm.
But I do see that there is still a massive flow of opportunities in that lower mid market where there's been less money raised, and therefore I think it's an exciting segment to enter, because part of your value is actually entering at a competitive terms as much as the business planning and what you do afterwards.
Mhm. And so, do you think like big tech companies could become some form of utilities companies in the next 10 years? I mean, when we see Meta, Google, OpenAI essentially investing in power plants like nuclear, hydro, etc., and primarily for their data centers and AI algorithm, etc. But if this keeps going, essentially AI grows more and more, and data centers grow more and more, tech companies will maybe become the prime investors in power generation. which means they will be very much, at the beginning of the entire value chain. I mean, do you think in some sort of not too distant world, those companies could become the new utilities?
Um, I mean, I think there's two ways to look at this. So one, if that would to become, I think you're in a situation where probably, there will be a very different view in terms of how governments view them as well, right? So I think you kind of get into a question on regulation, et cetera, which is, what a lot of utilities are subject to. And I think that's driven by that kind of natural monopoly position and how important and essential the service is. The other question is, are those companies doing this at the moment because that's the fastest way to grow? But actually, over time, do those assets sit well within on the balance sheet? So, to give a good example in the telecom space,
Hmm.
if you look at the mobile operators at the beginning, they owned and they basically built and owned all the infrastructure, including the towers, for example, right? But
Hmm.
over time, once they've gone through that kind of growth and go into more stable operations, they didn't really see the benefit of owning infrastructure, and they were able to sell it to infrastructure investors. So you could potentially see something similar here where, yes, you could have
Okay.
very kind of fast growth at the moment, and therefore sometimes it's easier to do it yourself. But actually, you see that over time, that's not the bread and butter, right? And therefore, is the benefit of them actually divesting it and using that capital from divestment into areas of where they want to be developing.
No, understood. Interesting. Maybe like on more personal sort of question. So as an investor, what's something you've learned the hard way?
Yeah, I mean, look, I think everyone's gonna say that you never have a perfect investment, and there's always, risk that you're taking within that investment, and it's about kind of thinking about, can you manage them or not,
Hmm.
and be able to get on the right side of the equation. I think that the key thing, that I've learned probably over the last how many years I've been on the principal side, probably 15 plus years, is asset management always takes longer, and it's almost the critical part of what you do in a way, because it's one thing being able to invest into an asset, but actually once you've already invested and then you're set with a certain structure, making sure that you can then deliver value always takes longer and more effort than one would expect on from day one.
So if we were asking CEOs of of companies in your portfolio, what would they say about you as a person?
Hopefully only great things. Joking
I'm
aside,
sure.
yeah, look, I mean, I think it goes back to what I said earlier. I think ultimately, I believe, in backing good management teams, and I have quite a lot of respect for what they do and their know-how, right? So
Hmm.
I think it's about A, that respect towards the management teams, and B, finding the opportunities where we can collaborate, and almost being very clear in terms of where the pockets of know-how are, and how to best work together.
Hmm.
And I think this has worked very well with the management teams.
So in terms of management teams, I mean, I guess you have people harder to deal with than others. Is it like something you pay attention to during, let's say, your due diligence phase? Like, are those people going to be like very hard to maybe coach, etc.? I mean, are you thinking about this really when you look at management teams?
Yeah, look, management team assessment is a key part, right? And
Hmm.
we actually even have senior advisors that actually do focus on that as well during the due diligence. Um, but also, over time, the company needs and the management teams evolve. So that input is not only kind of valuable on day one, but
Hmm.
it's something that we continue to work on, or kind of look to focus on. But it's not only just about management team. I think it's also about that interaction between the management teams and the shareholders. So, we spend quite a lot of time as well in terms of ensuring that the board works effectively, ensuring that actually it's a more of a kind of a 360 review of how we work together to achieve the key objectives, rather than just management and us, because ultimately it's a joint effort.
So you may walk away from an investment opportunity even if the management team is great in terms of performance, etc. Just because, I mean, they are very hard to deal.
It's potentially, yes. And obviously
Okay.
depends how instrumental that specific management team is to deliver your value, right? Because I think ultimately, there's not only one thing that you focus on. And the beauty of infrastructure is, yes, the management teams are very important, but you also have, that underlying investment of providing, essential service. So ultimately, there's a whole list of things that you kind of have to get right before you kind of make a positive investment decision.
Yeah.
And part of it is also just thinking about, can I manage that post investment as well?
Okay, got it. So we are coming to the end of our time. Maybe one last question before we go. Is there a book, a podcast, or a thinker you find yourself returning to for insight or inspiration? And would you have any of those, maybe podcast books to recommend?
I mean, the book that I actually read a long time ago, and I still actually find so relevant, is Harari's book, which is the 21 Lessons for 21st Century. And it's actually quite interesting, especially when you work in the infra world where, as we talked about it, there's very stable assets, etc. But actually, despite that, you still have to have quite a lot of flexibility, adaptability, but also that kind of question of, what kind of a data rich environment actually looks in the future and some of the pitfalls. So interesting enough, I think, most of those 21 lessons as they were in the books actually are quite relevant to what we do within infrastructure.
Okay, but I'll be sure to put it on my list then. Thank you very much for being with us and for your time.
Well, thank you for having me. It was great speaking to you.